You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. And today, of course, is Wednesday. It's the day when we talk to Zulfi Ali of Valerity Wealth. Welcome back, Zulf.
Hi, Buck. How are you doing?
Good, good. As a reminder, Zulfi is a former sovereign wealth fund manager who has a company called Valerity Wealth. Valerity Wealth effectively acts as a family office for people who are high paid, who are, otherwise fairly affluent, but who are not maybe ultra high net worth, so that they can afford necessarily to have their own family office. And so it brings all sorts of personal finance issues under one roof. And again, that's at valeritywealth.com, VELERITY wealth.com. All right, well, let's get to it. Zulfi, we usually start out with a review of the podcast for the week. And of course, this week, probably a little bit outside of your comfort level. We're talking about the business of buying internet businesses. Any thoughts?
Yeah, I think you stated it perfectly. Outside of my comfort zone, I definitely wouldn't know how to evaluate or run an internet business, an e-commerce focused business.
Right.
So it's something that I wouldn't necessarily jump into myself.
Well, any thoughts for somebody who is thinking about that and being sort of?
I think I think the guest you had on, he kind of talked about the origin story, right, for that business, which is really catering to people that have some expertise. So, they know how to do something within e-commerce. They have an idea that they can improve an existing business by adding their expertise to it and that sort of thing. I think that's probably the best type of investor that I can think of, because I think, you have to be actively involved in these businesses, right? So you're not necessarily just going to put in some money and have it be a passive investment. Although I think he was talking about a structure they've created to do that. But, again, that sounded like something that was pretty nascent, not much track record, not sure how that's going to end up. So, myself, I think this is one where, and I'm sure many of your listeners have some expertise in this area, and, it's probably a good source to check out some potential acquisitions.
Yeah, actually, my internet guy looked at it, and most of it is e-commerce. We looked at it from the perspective of, okay, what are we good at? We're pretty good at marketing and search engine optimization and those kinds of things. So it wasn't really necessarily in our sweet spot. Although arguably, if we had the group that could run the e-commerce side, we could probably ramp up the traffic to the site and that kind of thing. But I think it's a fairly complicated thing, and I would echo the concern about, people getting sort of eager and getting into this. I think the challenge is and I don't know much about that fund, but again, it sounds like a little bit of a startup, and it's sort of like matching you up with, people who are experts in this space. It sounds probably a little bit too Wild West to me. The issue is sometimes in these types of things, there's going to be pro formas that show pretty significant returns. But the problem with this kind of thing is, I think you're also dealing with a tremendous amount of risk. And I think people going into that with eyes wide open, sure, if you're willing to take that kind of risk. But again, I think you just got to be careful. So
I think that's right. To me, it seemed like a great place for guys who know how to kind of bootstrap one of these things up from nothing and then get it to just big enough where they can sell it. So it's a nice little way to sell a business. Right. But
in fact, that's what my internet partner and I were talking about is we do have some businesses that have been sort of used in the affiliate marketing space, at least in terms of plastic surgery and all that. And it could be something where we use them to sell those kinds of things or build some things that specifically resemble other businesses there. So yeah, that's a good point. Well, let's move on from that. Always we talk about the latest in the economy and the market. So what's going on this week?
Yeah, well, when we spoke last week, we had just received the latest jobs openings report. It had showed, there was a continued slowdown in the hiring, in the jobs open market. It was still positive, but it was decreasing. Since then, another labor market statistic came in. The May jobs report actually came in a bit higher than expected, and so it was going from, okay, everything's cooling as expected, back to, oh, wait a second, is the labor market still pretty strong and continuing to remain strong? I think generally speaking, the economy, inflation, labor markets are cooling, but it's not going to happen in a completely smooth fashion. You're going to get volatility from report to report, but I think the overall sentiment is it's still heading in the right direction in terms of taking a little gas off of the flame.
So in terms of implications, obviously the big question is going to be centered around interest rates. How many more meetings is it every month? I don't even pay.
No, they're not every month, but there is one in fact, there's one going on right now. It's spread over Tuesday, Wednesday of this week. Chairman Powell is expected to do a press conference on Wednesday. So right when, listeners will be listening to this. But again, he's got the latest data, and I think it would be really, really unexpected if he were to take a decision to reduce rates at this meeting.
Well, he's
I think
definitely not going to raise it either, right? So
well, no, I think the backdrop for all of this, Buck, is that the Fed and Powell want to cut rates. I don't think that they are thinking about do we possibly increase at this point? So I think it's more of a, do we hold steady? And for how long do we hold steady versus, do we cut? And I think the data can't yet support a decision by the Fed to cut just yet, because again, they don't want to make a mistake and have to reverse course and start raising rates again. But I think what, the market and economists are going to be listening for, not so much what's the June decision. It's probably going to be to keep things steady, but really what is, Powell going to potentially hint at for the rest of this year, if he hints at anything.
Right, because most economists are still talking about some potential rate cuts in 2024, right?
Yeah. I think 2 to 3 cuts is kind of the average expectation from economists, from market. And that's kind of what's baked into current stock market levels, the current bond market levels, all of that. So that's the expectation. I think most people will expect rate cutting to begin sometime in, some say September, some say November. I'm more of the November camp myself, just because I think,
they're not going to cut right before the election. There's no way.
I wouldn't think so, but I guess, if things were immediately necessary, then I guess they would probably act. But I doubt it, unless it's just a glaringly obvious decision to make.
Equity markets probably aren't doing a whole lot because they're thinking, well, nothing's going to really change after this meeting.
Yeah, I mean, when we spoke last week, they'd been down a little bit, 1 or 2%. Now, from last week to this week, their equity markets are basically up 1 to 2%. And I think you're going to continue to see that kind of volatility up and down, until we get some real, kind of a decision or direction on the rate markets. Same with the bond yields. The 10-year bond ticked up about 10 basis points over the last week, and it had ticked down the last time we talked. And gold and Bitcoin were going higher last week. Well, they're off their highs this week. So all in all, nothing dramatic, nothing drastic. I think we're kind of in a bit of a holding pattern on a lot of this stuff.
Sounds sort of a lot of the same, right?
Yeah, it's a lot of the same. There's some stuff underneath that, when you look at the equity markets performance, for example, the S&P is up, about 13% year to date. So that's a pretty handsome return for less than 6 months. What's interesting is if you look at what's driven that gain in that index, it's really been fueled by all of the large cap, trillion plus market cap companies. So those are the Microsofts, Apple, Alphabet, which is the former formerly known as Google, NVIDIA, Meta, Amazon. So those are the companies that, if you were to just take all of the companies that are above $1 trillion market cap, their prices have gained about 40% year to date, the stock prices. And then if you look at all the other companies, that are out there trading, and they're below that $1 trillion market cap, they have pretty much traded flat on the year, which I think is fascinating, right? You've got you've got just over a handful of stocks that are driving the performance of the index.
And most of those are tech.
They are all tech. You can argue that they are all very large, so they reach into lots of different segments of the economy, whether it's consumer with Amazon, whether it's business with Microsoft, whether it's advertising with Alphabet. They have their presence across the largest kind of subsectors of our economy, but they're driven by tech. And I think it's real important that you said that, because one of the reasons why they are all trading like they are is because the assumption that the AI boom is going to first manifest itself in these companies. And it has been, right? NVIDIA is where it is because it's making the very chips that support AI. Apple just out, yesterday at their big gathering, talking about all the AI strategies that they're going to be embedding in their phones and computers going forward. Obviously, the rest of these guys, all these very, very large companies, they have the capital to invest in AI. They have the ability to incorporate AI into, all the different products and services that they do. I think what we're waiting for is when that AI benefit trickles down to the rest of the companies that are not the $1 trillion companies. And I think that's kind of what you're seeing with the performance of the stocks that we just mentioned, the disparity between the trillion plus and the non-trillion market cap companies. I think it's because we're still waiting for the smaller companies, although some of those are still very large, to actually, start showing how that AI strategy is going to unleash that productivity and revenue gain for those companies. I think it'll happen, but it's not clear exactly.
So arguably, a lot of that, that gain is basically on FOMO, right? I mean, it's just fear of missing out on this AI revolution. Whereas if you look at the rest of the stock market, there's not a lot of enthusiasm across the board.
Yeah, I think there's FOMO, but I do think there has been an acceleration in the profitability of pretty much all of these companies. Yeah. So if you look at their performance in terms of earnings per share, revenue growth, multiple, all that is pretty strong, and it has been turbocharged with some of the AI stuff that they're doing.
Yeah, it was interesting. I actually did a Google search today. At the top of the page, they started with an AI summary. And I haven't seen that. And maybe it's been a while since I've used Google, because they've sort of switched to Perplexity. Do you know Perplexity?
I do know of Perplexity. I understand it's much more research driven and has it's less prone to some of the hallucinations that ChatGPT was doing.
It is. And it's also kind of a search. I mean, it's not like where you would search for restaurants or stuff like that, but for information right. and stuff like that, yeah. It's a little bit somewhere between like a Google and OpenAI. And also it's OpenAI is kind of annoying sometimes, like it won't answer certain questions or it won't give you opinions on things or whatever. But Perplexity seems to be pretty open-minded.
Yeah.
Okay, so I guess we should talk about real estate. I mean, what's going on in real estate, and what do you think of there?
Yeah, I mean, we talked about it last week, but I think it's good. It's still a very compelling time to get into real estate. I mean, we know that we're at a point now where buyers are able to negotiate better purchase prices, especially when there's distressed situations on the seller side. So you can get a perfectly good asset that, maybe didn't perform quite to what the pro formas were when, the seller bought it. but then the seller has distress because they've got a portfolio of assets to deal with, so they've got to start letting some of these go. So you can, buyers can negotiate much better opportunities to enter into these assets. And then I continue to think, okay, if I game theory it out, if inflation gets to a point where the Fed starts cutting rates because inflation has ticked down, real estate prices are going to go up because the financing ability has just allowed, the valuations of those assets to go up. And then if I take the flip side and I say, okay, inflation remains an issue, at the end of the day, what do you want to own in an inflationary environment? You want to own hard assets, and you want to own hard assets that you can leverage, because you can grow out of that leverage. So, I think it's a bit of a win-win right now in the real estate, sector. As long as the economy is generally doing okay, if you don't have a big, recession and that sort of thing, I think it's a good space to be in.
Yeah, I mean, I think if you can find something that's significantly distressed, or you can find something that you can do it on relatively moderate leverage. I mean, buying at higher interest rates has made a lot of real estate investors wealthy over the years, because as rates drop, those cap rates drop as well, and that is so. In that regard, it is a good time to buy, and it's probably a good time to remind people that if you're not part of Investor Club right now, the Wealth Formula Investor Club, go to wealthformula.com and sign up for Investor Club, because there is something brewing there literally within the next day or two. For those members of the accredited Investor Club who are onboarded, we'll see a really nice opportunity there. So go ahead and sign up for that and make sure you don't miss it if you're interested. Tell me more, just in terms of your overall optimism, pessimism. What's the deal?
I think overall, I remain optimistic. The equity markets, I think over the long term are still, they still have good potential to grow. I do think there's going to be a bit of choppiness continuing over the summer, especially as we start heading into the election cycle. The rates uncertainty and all that is just going to kind of play into it. So there's going to be some volatility, but over the long term, I am a believer that AI is going to, help a lot more companies with their profitability and efficiency and all that. So, I think it's an asset class you definitely want to continue to have exposure to.
Yeah. All right. Well, let's move on to a new segment not a new segment, but a segment that we've had for the last couple of weeks, started by accident, which actually ended up being a good thing, though, because I think it's an opportunity for people to learn about different types of things that, frankly, I don't really talk about much, because I'm so alternative, focused on real estate and various other alternative asset classes. But I've said it before and I'll say it again. I do think that I've sort of moved to being more open for diversity purposes, to round out portfolios. So it's important to kind of understand, what all these different things are. So today, why don't we talk about this topic? People have heard of mutual funds, and they've heard about ETFs, or exchange traded funds. What are each one of them? What are the differences? And, is one better than the other, et cetera?
Yeah, I think it's a great topic, Buck, because I have, as we at Valerity Wealth, as we've had investors get onboarded, we take a look at their investment portfolios, and we're finding that actually there's a fair amount of investors that do have a decent exposure to the equity markets. And we go through the process of trying to understand why certain investors have certain assets and how they've constructed a portfolio. And a lot of times, we see a lot of mutual funds in the portfolios, and we ask the question, well, what led you to believe that this is the right fund or the right structure to invest, particularly when an investor is looking for a very kind of passive strategy. And we'll get into that in just a second. But I think mutual funds versus ETFs, they're generally trying to achieve the same thing, right? Which is that they are investment fund structures, and they're pooled investment structures, so that many investors can buy into these, and they give you a broad exposure of some sort of strategy. In the past, most ETFs have been passive, so they've typically been pegged to a particular index. So you can buy an ETF that replicates the performance of the S&P 500 or NASDAQ, and so on and so forth. And mutual funds have historically been, a bit more actively managed. So you might, have a fund manager that says, we're gonna invest in U.S. large cap equities or something like that. So it's not necessarily pegged to a index, and the fund manager is actively managing that portfolio. Now, things have blurred.
Let me ask you this. I'm just curious when it comes to like ETFs, right? So you're in an S&P 500 ETF. How does that work mechanically? Like how do you track the S&P 500 like that in a given, do they buy basically the identical company?
Yep.
Is that, so it's basically like a mutual fund, except in this situation?
It is.
Okay.
It is. They are effectively actively purchasing the very stocks that represent that index.
Okay.
And so, they try to track as closely as possible. Obviously, it's not a perfect track, but, most of the time, and especially when it's the larger, more popular indices that they're trying to mimic, they're able to do that better versus, maybe more obscure stuff. So yeah, that is exactly what they're doing. And so that's why it's called a passive strategy, right? So they're not trying to say, we think Microsoft is better than Google, and therefore we're going to buy more Microsoft than Google. No, what they're doing is saying, okay, how much Microsoft is reflected in that index, and we're going to reflect that same amount in our ETF, and it's going to be the same proportionate, value to the index holding. So that's what's going on there. And when you get into more actively managed funds, that's different, right? So the fund manager has a lot of discretion what they're going to buy, when they're going to buy, what they're going to sell. They're not held to a specific, amount of shares or exposure to any particular company. There's some general parameters in terms of, concentration limits and that sort of thing, but they have the flexibility. The only thing I would say about that is that, there is a fair amount of truth to, if you've ever heard of that theory, monkey throwing darts and having a good chance of beating a stock picker, a professional stock picker.
Yeah.
Well, there's actually decent evidence to support that because you find that most actively managed funds underperform the overall market or a given index that they might be, pegging themselves against.
I mean, we even talked about that in the context of like Ray Dalio. Remember? So it's not even like we're talking about the, guy down the street who claims he's really good with stocks. We're talking about like legendary hedge fund managers and all that. So even Ray Dalio isn't really beating them. I don't think he's.
No, he's not. He's a great marketer. He's a great marketer, but he's, he's got certain strategies that, large institutional investors, for one reason or another, want to have exposure to those strategies, but they're not necessarily trying to, get a market exposure per se. Right. In fact, if you recall, a guy named David Swensen, who is, the Yale endowment guy, right? He is the guy that has been responsible for the very consistent and stellar performance of Yale's endowment for decades. And he is, passionately against mutual funds for that very reason, because most of them are actively managed. They tend to underperform passive index targeted funds like ETFs, and they tend to be more expensive too. So at the end of the day, he had a strong bias against mutual funds. And so, so when we're working with investors, we're typically, putting together kind of a portfolio of different passive funds, and they're typically in ETFs. ETFs trade like stocks, so you can buy them and sell them, pretty much immediately in the secondary stock markets. The prices change constantly; they reflect the kind of immediate market prices. Mutual funds, they're really only can be bought, or sold at the end of each trading day. And there's a mechanism where the mutual fund is actually redeeming your shares if you're selling them, or issuing you shares if you're buying them. And so that's a bit more of a process, and only happens once a day.
Is there like any kind of specific tax implications for one of the versus the other?
Yeah, there is. That is one of the major differences. Overall, ETFs are typically more tax efficient.
Because they're not buying and selling; they're just holding on to major stuff, right?
They are. They do have to buy and sell to keep in line with what the markets are doing, right? So, so there is a bit of that. Or if the S&P 500 index manager decides they're going to replace certain stocks with different stocks, so they've got to sell the ones that are being thrown out of the index and buy the ones that. So there is some, but for the most part, they're internalized, and those capital gains events are very, very rare. Whereas a mutual fund manager is, a lot of times selling securities to handle those redemptions or asset reallocations. And that generates, capital gains for shareholders, and shareholders can have capital gains implications even when they're sitting on unrealized losses of the overall portfolio, which kind of makes people a little unhappy to see that their fund is down, but yet they owe some taxes. So that's definitely a big thing to think about.
I guess the other thing that we always hear about when it comes to these two vehicles is fees, right? That's a big one. Yeah,
that's right. Yeah, mutual funds, they can have pretty significant, upfront fees, front end loads, they call them, or ongoing management fees can be higher, particularly if you've got some would-be hotshot manager who is trying to beat the market. He gets paid more than someone that a team that is just replicating an index. And then there's potentially fees when you're exiting, when you sell as well. So a lot of times these fees can depend on what class of mutual fund shares you have and how big your investment in the mutual fund is. If you've got like $1 million in a fund, then you can minimize your fees quite a bit. But if you're going in for 5,000, 10,000 at a time, those fees can be they can be a little onerous on you. So that's another thing to consider.
Bottom line is, overall, investors are better off with ETFs. I guess especially when they're investing with passive strategies.
Absolutely. That would be the takeaway as far as I'm concerned for the day.
Good enough. Well, I think that's enough for today. Thanks for joining me again. Zulfi is with Velerity Wealth, VELERITY, wealth.com. And obviously, Zulfi, if you describe Velerity Wealth for us again real quick.
Yeah, sure. We're a registered investment advisor. We take an integrated approach with respect to an investor and their investment strategy, tax efficiency, asset protection, all of that together. And we work with, either your professionals on those side, or we have folks on our side that can also bring it all together. So just think of us as your overall quarterback as you plan out your overall financial goals and go down that journey.
Fantastic. Thanks again, and we'll catch you next week.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.